Before we get into the data, a quick but important notice about what you are watching. This video is a statistical report of institutional positioning detected in options contracts. All premiums referenced were filtered and captured by dark gamma bots, flagged specifically on the ask side of the market. What that means is every flow we discuss reflects contracts where institutions were the aggressor, buying into the ask, which is how we distinguish directional conviction from passive or market-making activity. This is not investment advice. It is a structured analysis of positioning data. Use it as one input in your own process, nothing more. Welcome back to Dark Gamma's weekly institutional flow breakdown. We are covering the week of April 13th through 17th, 2026. Total filtered premium for the period landed at $1,573.2 million across 6 expiration windows. The global bias reads neutral, but that headline number is almost entirely driven by a single expiration, Friday the 17th, which alone absorbed $1,475.8 million in premium. 9,768 alerts, 1,971 sweeps, 272 tickers. That is not a normal weekly expiration print. That is a quarterly or semi-annual positioning event disguised as a weekly.
Right, and that neutral read on the global bias needs serious context. Strip out Friday and you are left with roughly 97.4 million in premium across the other 5 windows, and that residual flow is actually leaning bearish. Monday the 13th is the loudest signal in that subset. 62.5 million, 77.1% puts, 64 sweeps across 14 tickers. That is not retail hedging. That is directional institutional conviction expressed urgently. Sweeps tell you someone needed fills immediately. They were not passive. Tuesday and Wednesday both read neutral with balanced call-put splits around 50-50, low premium, low sweep counts. Thursday the 16th is almost negligible at 1.1 million, but the put bias there hits 79.5%, highest of the week on a percentage basis. Small size but clean signal.
The Thursday print is worth flagging precisely because of that contrast. 1.1 million total, only 6 alerts, 1 sweep, 2 tickers. When you see that kind of concentration with a near 80% put bias, you are likely looking at a single institutional desk buying downside protection on a very specific name or pair of names, rather than a macro hedge. The low sweep count confirms it was not aggressive. They worked the order quietly. Compare that to Monday, where 64 sweeps across 14 tickers tells you the bearish positioning was being executed across a broad basket, not a single thesis. That is macro hedging behavior on Monday versus idiosyncratic risk management on Thursday.
And then Friday the 17th completely resets the narrative from a size perspective. 50.9% calls, 49.1% puts, nearly perfectly balanced. But the sheer volume of 272 tickers and nearly 2,000 sweeps tells you this is monthly or quarterly options expiration mechanics at work. You are seeing dealers and institutions simultaneously rolling, closing, and re-establishing positions across the entire options chain. The neutral bias on a print that large actually means something. It suggests the institutional community is not making a strong directional bet into the next cycle at these levels. They are resetting exposure, not adding conviction. Monday the 20th shows the same neutral fingerprint at 10.5 million, with a very slight put lean at 52%, which is consistent with modest protective carry being added at the start of the new cycle.
So the takeaway for the week is this. The early flow through Monday and Thursday was genuinely bearish in character. Put heavy, sweep-driven, institutionally motivated. The Friday expiration is so dominant in dollar terms that it washes the global bias to neutral, but you cannot read that as a balanced market. The real story is in the structure of each window. Institutions used Monday to hedge or position bearishly with urgency. They used Friday as a mechanical reset, and the post-expiration Monday the 20th shows a market that is cautiously neutral, with a slight defensive tilt. We will go deeper into specific tickers and strikes in the sector-by-sector breakdown. Stay with us. Let's run through the earnings calendar for the week. Monday kicks things off with Goldman Sachs and Fastenal before the open, then FBK and ALOT after the close. The small caps are noise. Goldman is the real read there. Tuesday is where it gets serious. JP Morgan and Johnson & Johnson both reporting before the bell. These two together give you a simultaneous pulse on investment banking, consumer credit stress, and pharmaceutical demand. That is a lot of macro information hitting the tape at once.
On the volatility side, Goldman and JP Morgan are the ones to watch most closely for options positioning. Goldman implied volatility into earnings is typically pricing a move in the 4 to 6% range, and given the current uncertainty around trading revenue and deal flow, I would not be surprised to see the actual move push the upper end of that. JP Morgan is usually a tighter mover, more like 2 to 3%, but with net interest margin guidance under the microscope right now, any language around rate sensitivity could cause a sharp repricing. The financial sector ETF, XLF, will have gamma exposure heavily influenced by how these two resolve Tuesday morning.
Wednesday brings ASML before the open, and that one is critical for the semiconductor space. ASML is the only company in the world that makes extreme ultraviolet lithography machines. Their order book is a forward indicator for the entire chip production cycle. Then Bank of America also reports Wednesday morning, which rounds out the big bank picture alongside Goldman and JP Morgan. Thursday is the other standout session, Taiwan Semiconductor before the open, followed by Netflix after the close. Taiwan Semiconductor gives you real demand data on advanced node chips, and Netflix is still the bellwether for streaming subscriber momentum heading into the second half of the year.
Taiwan Semiconductor is probably the highest implied volatility name on the calendar relative to its recent realized moves. The market is pricing elevated uncertainty given ongoing geopolitical tensions around Taiwan and shifting customer capex guidance from the hyperscalers. Netflix implied volatility is typically pricing a 7 to 9% move into earnings, and with the ad-supported tier data expected to be a focal point, any beat on revenue per user metrics could be a significant upside catalyst. Wrapping up Friday, Truist and Fifth Third both reporting before the open. Those are your regional bank reads, and after the big bank reports earlier in the week, the market will be looking to see whether credit quality deterioration is spreading down the size spectrum. That sets up a very information-dense week for financial sector positioning.
Good morning and welcome back to Dark Gamma Institutional Flow. I'm Samantha, joined as always by Billy, and we are kicking off the week of April 13th with some serious data on the table. Monday session printed 62.5 million in filtered premium, 284 alerts, 64 sweeps, and the directional bias is unambiguously bearish. 77% of that flow landed in puts. Billy, before we get into the individual names, that single contract standing above everything else is the triple Q put at the 573 strike, $27.9 million in premium, 52 alerts, 3 sweeps, and open interest coming in at 0. Walk me through what you're seeing.
Yes, Samantha. That 0 open interest figure is the first thing that jumped out at me, and it completely changes the interpretation. When you see $27.9 million flowing into a contract that had 0 open interest heading into Monday, you are looking at fresh positioning. This is not someone closing an existing hedge. This is not liquidation of a prior trade. Somebody opened this entire position on Monday morning. Now, the strike itself tells you a lot. The triple Q was trading in the low 580s to mid 590s range heading into that week, so a put at 573 is slightly out of the money, maybe 1 to 2% below spot. That is not deep out of the money disaster protection. That is a precision strike placed very close to where the underlying is trading, which tells me this is tactical short exposure rather than a portfolio tail risk hedge. A pension fund or endowment hedging a long book doesn't do it in 52 alerts with 3 sweeps on a freshly opened contract at a near-the-money strike. That is an aggressive institutional participant or a large macro fund making a directional bet.
Let's quantify the scale here because I think people need to hear this number in context. $27.9 million is nearly 45% of the entire Monday premium total of $62.5 million. One contract, one strike, one expiration, and it dominates the entire day's flow. The 52 alerts suggest this wasn't printed in a single block, which would be the classic single desk hedge. Instead, we're seeing what looks like a distributed execution strategy, breaking up a very large order to minimize market impact. The 3 sweeps on top of that confirm urgency. When you sweep, you are telling the market you need fills now. You are willing to pay across multiple exchanges simultaneously. So you have size, you have distribution, and you have urgency. Billy, what does the Monday expiration itself tell us about intent here?
The Monday expiration is critical, and I think it's actually the most underappreciated data point in this whole setup. Options expiring on April 13th, which is the same day the flow was detected, have essentially zero time value left. You are buying pure intrinsic value play, or you are playing a same-day move. The implied volatility on a zero-day to expiration contract is almost irrelevant in the traditional sense. What matters is delta. At 573 strike with the triple Q near spot, you are getting a delta probably in the 0.4 to 0.5 range, meaning this $27.9 million position is effectively a leveraged directional vehicle for intraday or opening price movement. This is not a hedge against earnings next week. This is not protection for a multi-week drawdown. This is someone positioned for a move on Monday itself, or they opened it to capture an opening gap. The fact that open interest was zero means they either closed it same day or rolled. Either way, this is pure tactical activity.
Now let's place this in the broader context of the week, because the Monday flow doesn't exist in isolation. When you look at the full expiration ladder for the week of April 13th, the dominant weight sits at Friday, April 17th, $1.475 billion. 9,768 alerts, 1,971 sweeps, 272 tickers. That is a massive options expiration event, which is consistent with monthly expiration dynamics. But the interesting structural point here is that Monday's bearish flow at 62.5 million with 77% puts is acting as a directional signal at the front of a week that culminates in an enormous expiry. Billy, does the Monday positioning look like someone front-running a move that resolves into Friday's expiry, or is this genuinely same-day tactical activity?
My read is that you have two things happening simultaneously, and they are not mutually exclusive. The triple Q 573 put at 27.9 million with zero open interest and a same-day expiration is clearly tactical. That resolves Monday. But the broader Monday flow across the other top tickers, AAPL, Amazon, Broadcom, Google, Meta, IBIT, IWM, and Gold, that supporting cast of bearish positioning across 8 distinct names suggests a coordinated macro view being expressed across multiple instruments heading into what is a very significant weekly expiry. The 64 sweeps on Monday across 284 alerts means execution desks were active and urgent across the board. When you see gold through GLD showing up alongside equity names and the iShares Bitcoin Trust on a bearish flow day, you are watching someone hedge or position against risk-off conditions broadly, not just equity volume but also crypto and commodity exposure. That is institutional scale thinking, not a retail trader picking a direction on one name.
All right, Billy, let's dig into the midweek picture for the week of April 13th through 17th, 2026. We've got a total filtered premium of $1.573 billion across the full week, and the global bias is reading neutral, but that headline number is almost entirely dominated by Friday's expiration. Before we get there, walk me through Wednesday, April 15th, because I think the setup on that day is actually more telling than people give it credit for.
Wednesday was a quiet session on the surface. 15.8 million in filtered premium, 131 alerts, 34 sweeps across 14 tickers, and the put-call split lands at 48.2 calls versus 51.8 puts. So you've got a very slight put lean, barely enough to call it directional. But here's what matters. 14 tickers showing up with 34 sweeps on a midweek expiry tells me institutions were actively positioning, not just rolling. Sweeps are urgency orders. Someone needed fills fast. The question is what they were positioning for. And I think Wednesday was the setup trade for what explodes on Friday.
Exactly. Now let's bring in Friday, April 17th, because this is where the week lives and dies. $1.475 billion in a single expiration, 9,768 alerts, 1,971 sweeps, 272 tickers. The split is 50.9 calls versus 49.1 puts, essentially a coin flip on the bias. But the two contracts I want to focus on immediately are the triple Q put at $588 strike carrying 22.3 million in premium across 77 alerts and 8 sweeps, and the SMH put at $405 strike with 13.9 million, 39 alerts and 18 sweeps. Both of those show zero open interest. Billy, that's new positioning, not a roll. What does that tell you?
Zero open interest on both is the critical data point. When you see a contract with substantial premium and zero open interest, you are looking at fresh exposure. These contracts did not exist before Friday's session. The triple Q put at 588 with 22.3 million is not a hedge against an existing long position in most retail books. That strike is deep enough to imply someone is paying for meaningful downside protection or outright speculating on a move lower in technology. 18 sweeps on the SMH put at 405 is even more aggressive. SMH tracks semiconductors, and 18 sweeps means that order was broken up and routed urgently across multiple exchanges. That's institutional footprint, not algorithmic noise. Together, you're looking at over $36 million in single-day put premium concentrated in 2 semiconductor and technology-adjacent vehicles, both freshly opened, both swept. That is a deliberate sector bet.
And when you put Wednesday alongside Friday, the cross-expiry hedging narrative becomes clearer. Wednesday's 52% put lean across 14 tickers, while small in dollar terms could represent the initial hedge layer being established ahead of a known event or a macro catalyst expected into Friday's close. Weekly expiration on April 17th is also an options expiration with significant gamma exposure potential given the size. The institutions that put on the triple Q 588 puts and the SMH 405 puts on Friday were not surprised by market conditions that day. They had a thesis built earlier in the week. Wednesday's flow was the whisper, Friday was the shout. The fact that the overall bias on Friday still reads neutral, despite that put concentration in tech and semis, tells me the other side of the ledger, the call side, was equally active across different sectors, which is a classic dispersion or rotation signature.
That dispersion read is important. $1.475 billion printing neutral means the put premium in triple Q and SMH was being offset by call buying elsewhere across those 272 tickers. 1,971 sweeps on a single expiration day is an extraordinary number. For context, Monday, April 13th had 64 sweeps on 62.5 million in premium. Friday had nearly 2,000 sweeps on over 14 times the premium volume, but the urgency ratio is actually compressed because the premium per sweep is much higher. That means large block orders were being executed with precision, not panic. This was organized institutional activity, hedging books into the weekend, rolling gamma exposure, and in the case of the technology puts, establishing new directional risk into a potentially volatile Monday open on April 20th.
And Monday, April 20th confirms that thesis partially. 10.5 million, 75 alerts, 36 sweeps, and a slight put lean at 52% puts across 11 tickers. That's not massive follow-through, but the sweeps to alerts ratio on Monday is actually high. 36 sweeps out of 75 alerts is a 48% sweep rate, meaning nearly half of Monday's alerts were urgency routed. Compare that to Friday, where 1,971 sweeps out of 9,768 alerts is only about 20%. So Monday's smaller flow is punching above its weight in terms of conviction. The week's story is this: Wednesday built the hedge, Friday was the expiration-driven machine executing at scale in both directions with a clear sectoral put bias in tech and semiconductors. And Monday's elevated sweep rate suggests whoever put on those Friday puts in triple Q and SMH was watching the tape very closely for follow-through. This was not a neutral week, it was a week wearing a neutral mask. Let's get into the sector breakdown for the week of April 13th through 17th. Total filtered premium came in at $1.57 billion, and the headline bias reads neutral. But Billy, that neutral tag is doing a lot of heavy lifting here. When you break it down by sector, the picture is anything but balanced.
Exactly right. The number that jumps out immediately is Friday the 17th. $1.475 billion in a single session, 9,768 alerts, 1,971 sweeps across 272 tickers. That is overwhelmingly an options expiration rebalancing event. The sheer breadth, 272 tickers, tells you this is systematic, not directional conviction. Dealers and large institutions rolling and closing positions at expiry. That single day is why the weekly bias reads neutral. It statistically drowns out everything that came before it.
And when you strip Friday out, the early week is clearly bearish. Monday the 13th was $62.5 million with 77.1% puts, only 14 tickers and 64 sweeps. That is concentrated, aggressive put buying, not a hedge spread across a portfolio. Someone was making a directed bet going into the week. Then Thursday the 16th, small and premium at 1.1 million, but again 79.5% puts across only 2 tickers and 1 sweep. That is a very targeted continuation of bearish positioning in specific names.
Now looking at sector allocation, semiconductors led the week at $309 million with a nearly balanced 48 calls to 52 puts split, reading neutral. But I want to be careful here. In semis, when you see slight put dominance and neutral classification after a week with that kind of early bearish flow, the more likely interpretation is institutional hedging rather than outright directional bets. Portfolio managers with large semiconductor exposure, think names across the Philadelphia Semiconductor Index, routinely layer put protection when macro uncertainty is elevated. The neutral label masks defensive accumulation in the options chain.
The sector that concerns me most is index ETFs at $298 million with a 41 calls to 59 puts split. That is the only sector the data explicitly tags as bearish. This is institutional hedging at the macro level. When you see that kind of put bias on index ETFs, think S&P 500 and QQQ products specifically, it signals that large allocators are buying downside protection against their equity book. This is not speculative, this is risk management. The implied volatility environment around that Monday flow would have made those puts expensive, which means whoever bought them was willing to pay a premium for protection. That is conviction.
Mega cap tech came in at $137 million with 54% calls, the only sector showing genuine call bias this week. That is a meaningful divergence. While index ETFs were being hedged aggressively, someone was selectively buying upside in individual large-cap technology names. This is a classic bifurcation trade. Protect the broader market exposure with index puts, while staying long or adding exposure to high-conviction single names in tech. Institutional desks run this playbook when they believe macro headwinds are real but specific secular growth names will outperform regardless. The $137 million in premium is not enormous relative to semis or index ETFs, but the directional clarity of the call bias makes it the most unambiguous bullish signal in the week. Net read for the week, institutional desks were hedging the index, selectively accumulating in mega-cap tech, using semis as a defensive covered position, and the Friday expiry wash reset the board heading into the following week.
Billy, let's break this down because the polymarket data coming into Monday is telling a very specific macro story. We have QQQ at 81% probability of a gap down with a 2.0 gap expectation, S&P 500 ETF at 61% down with a 3.8 gap, and Amazon sitting at 75% down with a 2.4 gap. That is not noise. That is coordinated bearish sentiment across the most liquid instruments in the market. When you see the tech complex, Amazon, Meta, QQQ, all flagged simultaneously with high conviction, the options market should be pricing elevated implied volatility on Monday open, and institutions who were already positioned short gamma into the weekend are going to be very uncomfortable if any of those gaps reverse.
Right, and the crude oil signal cuts directly against the equity bearishness, Samantha. 82% probability of a gap up on West Texas Intermediate with a 2.9 gap expectation. That is the strongest directional conviction on the entire board. Now here is where it gets interesting institutionally. A rising oil gap does not coexist peacefully with a tech sell-off by accident. What we are almost certainly looking at is a geopolitical risk premium being priced into energy simultaneously with a risk-off rotation out of growth equities. The institutional flow implication is real money moving into energy calls and out of tech longs. Watch the December crude contracts around the $90 and $95 strike calls for fresh open interest accumulation Monday morning. If those are being bought into the gap, that confirms speculative positioning, not just hedging.
Now let's talk about the insider polymarket trades, because this is where the contradiction lives, and it is glaring. You have 12 insiders putting $189,000 into Trump acquiring Greenland before 2027 at 9% odds. 9%. That is not a value bet on expected value alone. That is either an information edge or a narrative hedge. But cross-reference that with the Iran cluster, 9 insiders at $330,000 into the regime falling by June 30th at 11%, 11 insiders at $112,000 into regime collapse before 2027 at 24%, and 7 insiders at $37,000 into a U.S. invasion of Iran at 36% before 2027. The total capital deployed into Iran-related geopolitical tail risk is nearly $500,000 across those 3 contracts. That capital concentration is the reason crude is gapping up. These are not independent signals.
Exactly, and the options flow connection here is critical. If institutional desks have any visibility into the same geopolitical intelligence that is driving those polymarket insider bets, then the energy sector options market should be showing unusual accumulation in names like Exxon, Halliburton, and in the Energy Select ETF calls. Specifically, watch the Energy Select ETF at the $90 and $93 strikes for January and February expiration. Any surge in open interest there that is not matched by delta hedging activity in the underlying tells you these are directional bets, not portfolio hedges. Meanwhile, the contradiction with the Greenland play is that 12 insiders committing nearly $200,000 at 9% odds into a territorial acquisition suggests some participants believe there is a broader geopolitical restructuring narrative being underpriced across multiple theaters simultaneously. That is a bold macro bet.
Let's talk about the contrarian setups, because the crowd is heavily positioned bearish on tech going into Monday, and that asymmetry creates opportunity. When 81% of polymarket participants expect Triple Q to gap down and 75% expect Amazon to gap down, any catalyst that reverses that consensus, a Fed speaker walking back hawkishness, a geopolitical de-escalation headline, even a strong pre-market institutional block buy, creates a violent short squeeze in names where put open interest is already elevated. On Amazon specifically, the $300 and $310 strike puts for this week's expiration are likely heavily loaded. If Amazon opens flat or positive against a 75% down consensus, those puts lose value catastrophically fast. The contrarian long here is a defined risk call spread on Amazon, something like the 310 to 320 call spread expiring this Friday, bought into the gap down open if it materializes and holds support.
And the macro synthesis for the week, Samantha, is this. The institutional positioning narrative has 2 distinct layers running simultaneously. Layer 1 is the near-term equity risk-off trade, tech selling off, implied volatility elevated on S&P 500 and Triple Q, put open interest concentrated in growth names. That is the consensus trade, and it is crowded. Layer 2 is the longer duration geopolitical risk premium, crude gapping, energy calls accumulating, and nearly $500,000 in polymarket insider capital betting on Middle East instability and U.S. geopolitical expansion scenarios. The tension between those 2 layers is the trade of the week. If the geopolitical risk escalates and crude continues higher, energy becomes the institutional safe haven trade, and the tech put thesis gets complicated by sector rotation dynamics rather than a clean risk-off move. The cleanest institutional flow to watch for confirmation Monday morning is whether S&P 500 futures put buying accelerates or whether energy ETF call volume spikes first. Whichever moves first tells you which narrative is driving the week.
Let's get into it. The institutional flow reading this week is neutral bias, but the macro backdrop is anything but neutral. You have Trump announcing an immediate blockade of the Strait of Hormuz, Iran-US talks breaking down, and equity markets described as subdued. That combination should be screaming for elevated implied volatility and aggressive put buying on the S&P 500, but the flow says neutral. That contradiction is the most important thing on the board right now.
Exactly, and when you break down what neutral flow actually means in this context, it is not complacency, it is paralysis. Institutions are not directionally committed because the Hormuz situation has two completely opposite resolution paths. If the blockade is more diplomatic posturing than physical enforcement, crude pulls back, geopolitical premium bleeds out, and you get a relief rally. If it escalates into actual naval confrontation, you are looking at oil spiking above 110, inflation expectations repricing hard, and the S&P 500 losing 4 to 5% inside a week. Neither scenario has a dominant probability right now. So the smart money is sitting in delta-neutral structures rather than taking outright directional exposure.
On the implied volatility side, the VIX term structure is where I would focus attention. Near-term implied volatility on the S&P 500, specifically the weekly and two-week tenors, should be carrying a meaningful geopolitical premium right now. The put skew at the 25 delta on monthly S&P 500 options should be steepening. I would expect the skew spread between 25 delta puts and 25 delta calls to widen by at least 1 to 2 volatility points relative to the 30-day average. Earnings season kicking off simultaneously is compounding this because single-name implied volatility is elevated, which feeds into index realized volatility expectations. That keeps the volatility surface bid, even if the flow reading looks flat on a delta basis.
The tail risk architecture this week has 3 distinct layers. First layer is the Hormuz blockade itself. Oil infrastructure is the transmission mechanism. A physical disruption to roughly 20% of global oil supply does not just move energy, it blows out credit spreads, hits airlines and industrials catastrophically, and forces a Fed narrative reprice because stagflation becomes a real word again. Second layer is the Iran refining recovery story. That Reuters headline about Iran restoring refining capacity within 2 months is actually a downside risk to oil bulls, which means if markets start pricing that in, crude softens and the geopolitical fear trade partially unwinds. Third layer is the earnings season overlap. If a major bank or tech name misses this week while geopolitical noise is at peak volume, you get a compounding sell-off that is much harder to fade because it has 2 independent catalysts.
For positioning, an institutional trader in this environment should be running a defined risk structure. The playbook I would execute is a ratio put spread on the S&P 500, something like long the 5,500 put and short 2 of the 5,200 puts at the monthly expiration. That structure gives you meaningful protection in a moderate down move, cost close to zero given the elevated skew, and your only problem is a catastrophic gap below 5,200. You pair that with long crude volatility through USO calls or outright long positions in energy implied volatility, because if the tail scenario hits, energy volume is your best hedge. The neutral flow reading actually supports this. Institutions are not loading up on outright puts, they are buying volume in correlation plays.
The contradiction between the neutral institutional flow and the macro backdrop has one more layer worth unpacking. The ADNOC chief executive saying Hormuz is not Iran's to control, that is a Gulf producer signal that supply security will be defended. That headline is structurally bearish for crude volatility premium over a multi-week horizon because it implies regional actors will resist Iranian leverage. So you have a situation where the near-term implied volatility should stay elevated due to uncertainty, but the 2 to 4 week forward implied volatility could actually compress if the diplomatic and military signals converge toward de-escalation. That is a volatility term structure trade. Sell the front month implied volatility spike and buy second month implied volatility, because the event risk is concentrated in the next 5 to 10 trading days. The neutral flow this week likely reflects institutions executing exactly that structure rather than taking naked directional bets.
Bottom line for this week, the neutral institutional bias is not a green light. It is a signal that professionals are hedging asymmetric risk with precision rather than chasing direction. The implied volatility surface on the S&P 500 deserves a 5 to 7 point premium above the 6-month realized volatility baseline, given the Hormuz situation alone. The put skew should remain steep, and any compression in that skew is a selling opportunity for volatility, not a buying signal for equities. Watch the 5,400 level on the S&P 500. If price action fails there on elevated volume, institutions will start converting their delta neutral hedges into net short delta exposure. That is the tripwire that turns the neutral flow reading into a bearish one, and it could happen fast given how many pending risk events are stacked into the same 5-day window. All right, Billy, let's dig into this one because the data here is striking. We're looking at a triple Q put at the 588 strike expiring April 17th, 2026. $22.3 million in total filtered premium, 77 detected alerts, 8 sweeps. And here is the critical detail. Current open interest is 0 contracts.
Zero open interest with 22.3 million in premium is the headline. That tells us this entire position was built today, intraday, from scratch. There was no prior accumulation. Someone decided right now, at this moment, to deploy over $22 million into downside protection or a directional bearish bet on the triple Q with roughly a year of runway.
Let's talk about this sweep activity. 8 sweeps out of 77 total alerts. Sweeps tell us the buyer was aggressive. They were hitting multiple exchanges simultaneously, prioritizing speed of execution over price. You don't sweep a put contract 8 times across a single session unless you're either very large, very urgent, or both. This is not a retail trader scaling into a position. Retail doesn't move like this.
Right, and the strike itself is meaningful. 588 on the triple Q is right around current market levels depending on where we're trading today. This is not a deep out-of-the-money lottery ticket. This is an at-the-money or near-the-money put, which carries substantially higher premium per contract and much higher delta sensitivity. Whoever bought this wants real exposure to a move down, not a tail risk lottery.
So let's talk about who this likely is. Given the premium size, the sweep behavior, the 0 open interest baseline, and the April 2026 expiry, we're almost certainly looking at an institutional actor. The expiry gives them roughly 12 months of duration. That's a hedging timeframe, not a speculative week-to-week play. Hedge funds, large asset managers, or even a treasury desk, protecting a tech-heavy long book, would structure a position exactly like this.
I'd lean toward hedging over pure speculation here, but I want to be careful with that read. The at-the-money strike complicates the hedging narrative slightly. True portfolio hedges tend to be placed out of the money. Think 500 strike, 520 strike, where the premium is cheaper and you're buying catastrophe protection. 588 is expensive. It's closer to a conviction trade than a cheap insurance policy.
That's a fair point. So maybe the more accurate framing is this. It could be a hybrid, an institution with a concentrated long position in triple Q, or tech names buying near the money puts to lock in current levels. They're not just hedging a crash, they're hedging any meaningful drawdown from here. 588 is essentially saying, I don't want to lose money if the triple Q drops even 10 or 15% over the next year.
And 22 million in premium for that level of protection implies the underlying long book is significantly larger. If we're talking a delta hedge at roughly 0.4 to 0.5 delta for a near-the-money put, and the premium alone is 22 million, we could be looking at a long book in the hundreds of millions of dollars that this position is protecting. This is a serious institutional actor.
Now let's talk implied volatility implications. Buying $22 million in a single put contract name in a single session is a volume buying event. If implied volatility on the triple Q was already elevated, this buyer paid up significantly. If implied volatility was compressed, which it has been in recent months, this is actually a smart entry for a long duration put. Low implied volatility means cheaper premium, and locking in a year of downside protection at a low volume environment is textbook institutional thinking.
Before expiration in April 2026, here's what we watch. First, does open interest build further in subsequent sessions? If we see the open interest on this 588 put grow meaningfully in coming days, it means either the same actor is adding or other players are piggyback trading the flow. Second, does the position start rolling earlier than expiration, say around January or February 2026, which would suggest active management of a hedge? Rolling behavior is very institutional.
And third, watch the gamma exposure picture for triple Q broadly. If this contract starts accumulating more open interest from other traders who read the flow, market makers will be net short puts and forced to hedge by selling triple Q on the way down. That creates a feedback loop. Meaningful downside in triple Q could get amplified by dealer hedging mechanics around this strike.
Bottom line on this contract, 22.3 million in premium, 0 prior open interest, 8 aggressive sweeps, April 2026 expiry at the 588 strike. This is a single-session institutional build. The actor is large, moved with urgency, and bought meaningful duration near the money. Whether pure hedge or directional conviction, the message is clear. Someone with serious capital is positioning for or protecting against a material decline in the triple Q over the next 12 months.
And that's not noise. 22 million in a single name put contract, built in one day from nothing, is one of the cleaner institutional signals you'll see in the options market. We'll be watching open interest on this strike closely in coming sessions. If it stays at the opening day level, it's a one-and-done hedge. If it grows, the story gets much more interesting. Billy, we are looking at a triple Q put at the 573 strike expiring April 13th, 2026, $27.9 million in total filtered premium, 52 detected alerts, and 3 sweeps. Here's what immediately stands out. Current open interest is 0 contracts.
0 open interest is the critical data point here. That tells us this position was either opened and closed within the same session, or we are looking at activity that has not yet settled into the open interest print. Given the size, nearly $28 million, and the sweep activity, this is not retail. Nobody sends 3 sweeps across exchanges on a single put strike without institutional intent.
Let's break down what sweeps mean in this context. A sweep is an aggressive fill. The buyer or seller is prioritizing speed of execution over price, hitting multiple exchanges simultaneously to get the full size done. 3 sweeps on this contract suggests urgency. Combined with 52 alerts, which indicates repeated layered orders over time, this is not a single block trade. Someone was building or exiting this position in tranches.
The 573 strike on triple Q for April 2026 puts this roughly in the range of a 4 to 6% downside target from where triple Q has been trading in the mid-500s to low 600s recently. That is not a catastrophic out-of-the-money put. That is a near-the-money or slightly out-of-the-money hedge, the kind of strike a large fund uses to protect a tech-heavy portfolio against a meaningful but not apocalyptic drawdown.
But here's where I push back on the pure hedging narrative, Billy. If this were a clean institutional hedge, think a large asset manager protecting a long equity book. We would expect the open interest to reflect the held position. 0 open interest after 27.9 million in premium flow is anomalous. It suggests either same-day open and close, which would make this a speculative directional trade that was unwound quickly, or there is a reporting lag we need to monitor into tomorrow's open interest print.
That is a fair point. If open interest prints above 0 tomorrow morning, this is a hedge or a new speculative position being held. If it stays at 0, someone took a $27.9 million intraday bet on the downside in triple Q and closed it the same day. That kind of behavior is consistent with a macro hedge fund reacting to a specific intraday catalyst, maybe a Federal Reserve comment, an economic data print, or geopolitical news, and then unwinding once the event passed.
The April 13th, 2026 expiry is also meaningful. That is roughly 1 year out, which gives this position substantial time value. Implied volatility on a 1-year triple Q put at this strike is going to be elevated relative to historical norms, given current macro uncertainty. Paying that kind of premium for a 1-year put is either a serious macro thesis, someone believes tech faces structural headwinds into next spring, or it is a portfolio hedge being locked in for the full year.
Think about what a $27.9 million premium buys you in terms of notional protection. At 573 strike with 1 year to expiry, depending on where triple Q is priced and what implied volatility looks like, you could be looking at anywhere from $200 to $400 million in notional downside exposure being hedged. That is a large institutional book. We are talking a major asset manager or a sizable hedge fund with significant triple Q or NASDAQ exposure.
The 52 alert count is high relative to the 3 sweeps. That disproportion tells me the majority of the activity was not aggressive sweeps. It was more measured, perhaps limit orders being filled over time. That is more consistent with a patient institutional accumulator rather than a panic hedger. Patient accumulation of a put position over a session suggests conviction, not reaction.
So here is the synthesis. We have 2 scenarios. Scenario 1, open interest prints tomorrow and this is a held position. That means a large institution has entered a one-year bearish or hedging thesis on the Nasdaq, targeting the 573 level, with enough conviction to spend nearly 28 million in premium. That is a significant macro signal, and we should watch for similar positioning in S&P 500 puts or volatility products as confirmation. Scenario 2, open interest stays at zero. That is an intraday speculative play that was opened and closed, which tells us someone saw a very specific short window of downside risk and acted aggressively to monetize it.
What to watch before the April 2026 expiration? First, tomorrow's open interest print is the immediate tell. Second, watch implied volatility on the triple Q put skew. If more premium flows into the 550 to 575 strike range over the coming weeks, this was the start of a broader positioning campaign. Third, monitor triple Q price action around the 573 level itself. If the ETF trades down toward that strike, whoever holds this position will have significant gamma exposure that could accelerate selling pressure as dealers hedge their short gamma. This contract matters.
Bottom line, $27.9 million does not move through 52 alerts and 3 sweeps by accident. Whether this is a hedge or a speculative directional bet, someone with serious capital has a view that Triple Q faces meaningful downside risk between now and April 2026. The zero open interest question is the hinge point. We will know a lot more tomorrow morning.
All right, Billy, let's dig into this one because it's genuinely unusual. We're looking at the semiconductor ETF, ticker SMH, put strike 405, expiring April 17, 2026. $13.9 million in total filtered premium, 39 detected alerts, 18 of those being sweeps, and here's the kicker, current open interest is 0 contracts.
Zero open interest with nearly $14 million in premium and 18 sweeps. That means every single contract printed today and nothing carried over from prior sessions. This position was built entirely fresh, and the sweep count tells us it was built aggressively. Someone was not patient. They were hitting multiple exchanges simultaneously to fill size without telegraphing the order.
Right, and sweeps at that ratio? 18 out of 39 total alerts, that's a near 50% sweep rate. Retail doesn't sweep. Retail uses limit orders and waits. When you see that sweep density on a single strike, single expiry, you're looking at institutional execution. The question is always whether this is a hedge on an existing long book or a directional speculative bet against semiconductors.
Given the structure, I lean heavily toward a directional macro position rather than a pure hedge. Here's why. If this were a hedge on a long semiconductor portfolio, you'd typically see the flow spread across multiple strikes, a put spread, a collar structure, or at minimum staggered expiries to reduce cost basis. A single strike, single expiry, $14 million put at 405 is a clean, concentrated expression of a thesis. Someone believes SMH is going to 405 or below before April 2026.
Let's put that strike in context. 405 on SMH implies a meaningful drawdown from current levels, depending on where the ETF is trading. This isn't someone buying deep out of the money lottery tickets. A strike at 405 is serious. It's positioned to capture a substantial decline in the semiconductor complex. Names like Nvidia, TSMC, Broadcom, ASML. One contract here represents a view on the entire sector.
And the April 2026 expiry gives them roughly 12 months of runway. That time frame is very deliberate. It covers multiple Federal Reserve meetings, multiple earnings cycles for the major semiconductor names, and critically, it overlaps with potential policy risk windows, tariff cycles, export control reviews, geopolitical pressure around Taiwan. Whoever put this on is not thinking about next week's price action.
The zero open interest starting point is also important to flag for our listeners. This is day one accumulation. We are watching the birth of a position, not someone adding to an existing book. That makes the premium flow even more significant because there's no averaging in from prior sessions. 13.9 million went in clean today at this strike. That's conviction.
Now what could happen before expiration? 3 scenarios. First, the thesis plays out. Semiconductors sell off meaningfully. SMH breaks 405, and this position goes deep in the money. Second, the position gets rolled earlier. If implied volatility spikes due to a macro shock, the buyer could close at a profit even without the full price move, because the option would reprice dramatically. Third, the trade is wrong. SMH holds or rallies, implied volatility compresses, and the premium bleeds out over 12 months.
The implied volatility angle is underrated here. Buying a 12-month put means you're paying for a lot of time value. If you're wrong directionally but implied volatility rises sharply, say on a geopolitical escalation or a major earnings miss from Nvidia, you can still monetize that position. So even in a scenario where the price doesn't move much, a volatility event could make this trade profitable.
To summarize the read, institutional actor, almost certainly a macro or quant fund, building a 12-month directional put position on SMH at 405. Execution via aggressive sweeps across exchanges confirms urgency and scale. Zero prior open interest confirms this is fresh positioning, not a roll or accumulation play. 13.9 million in premium represents substantial committed capital, and the April 2026 expiry signals a thesis tied to medium-term sector risk, likely involving the global semiconductor supply chain and regulatory environment.
We'll be watching open interest builds on this contract daily. If this is the start of a larger accumulation campaign, you'd expect to see follow-on flow in the coming sessions, additional sweeps, premium layering, potentially adjacent strikes getting hit. If the flow stops here, it was a one-time institutional decision. Either way, SMH 405 April 2026 is officially on the radar. While everyone watches this Friday, institutional money is already positioned for next Friday.
Next week's bias points bearish. Institutions are already pricing in a weaker market ahead.
All right, Billy, let's wrap up the week of April 13th through 17th, 2026. Total filtered premium came in at $1,573.2 million, and the global bias printed neutral. But that headline number is almost entirely dominated by Friday the 17th, which alone accounted for $1,475.8 million. That's over 93% of the week's total premium in a single session, with 9,768 alerts and 1,971 sweeps across 272 tickers. That is not a normal expiration Friday. That is a full institutional repositioning event.
Right, and the structure of that Friday flow is what makes it interesting. The split was 50.9% calls versus 49.1% puts, essentially a coin flip, which is why the algo tagged it neutral. But neutral on that volume doesn't mean complacent. When you get that kind of premium deployed with near-perfect balance across 272 tickers, you're looking at a massive delta hedging and gamma reset cycle. Think of it as institutions rolling their books, closing April exposures and reloading for May and June. Now contrast that with Monday the 13th, which was the most directionally clean day of the week. $62.5 million, 77.1% puts, 64 sweeps across 14 tickers. That's not hedging noise, that's someone aggressively buying downside protection into the open of the week, likely tied to macro event risk around that date.
And Thursday the 16th reinforces that early week bearish thesis. Only 1.1 million in premium, but the put concentration hit 79.5%, the highest put bias of the entire week, with just 6 alerts and 1 sweep. Low volume, extreme skew. That's a targeted institutional position, not retail noise. Someone was quietly adding tail risk insurance. Then you bookend the week with the Monday, April 20th flow coming in at 10.5 million, 52% puts, 36 sweeps across 11 tickers. That slight put lean post-expiration suggests the hedging posture didn't fully unwind after Friday's reset. Whoever bought protection early in the week may have rolled a portion of it out past expiration rather than letting it expire flat.
So here's the synthesis for the week. The institutional narrative reads like this. The week opened with a clear bearish hedge, heavy put sweeps Monday morning, confirmed again Thursday with that extreme put skew on minimal volume. Then Friday delivered a massive bilateral reset that neutralized the directional signal at the surface level. But the sheer scale of that single-day repositioning, nearly $1.5 billion, almost 2,000 sweeps, tells you institutional desks were making significant structural changes to their options books heading into late April and May. The Tuesday and Wednesday sessions were transitional and largely noise by comparison. Net takeaway: the neutral global bias this week is technically accurate but contextually misleading. The real story is a bearish opening posture, a quiet midweek hedge build, and a massive Friday expiration event that reset the board entirely. As always, nothing here constitutes investment advice. This is flow interpretation, not a trade recommendation.
Want to see exactly what institutions are doing in the market in real time? Then this is for you. Exclusively for members of the Dark Gamma community, the SPX trading platform is currently in beta, and access is completely free until the official launch. Go to the link on screen, sign up, and in the discount field, enter the code shown on screen to also activate 1 free month on the institutional levels bot tool. From the platform, you will see the complete market X-ray, institutions trading live, liquidity zones, points of interest, unusual positioning, everything that moves the price of SPX visible on your screen in real time. No prior experience needed. Just get in, explore, and start seeing the market the way institutions see it, like you never have before. Take advantage of this access before it closes.
That wraps up today's institutional flow analysis. If you want to dig deeper into everything we covered, the open interest shifts, the gamma exposure levels, the hedging activity, head over to darkgamma.trading, where the full dashboard is live and updated in real time. And if you have not subscribed yet, now is the time. Hit that subscribe button so you never miss a week of this.
Seriously, the dashboard is where the real edge is. You can track every contract we talked about today, watch the open interest move in real time, and see exactly where the institutional money is positioning.